partner CRED, country partner Australian government, track partner HSBC India and Revenue India, session partner the UK government, Department of for International Trade. We are here to discuss a very crucial topic on democratizing credit with innovative solutions, pay later credit card. Without any further ado, let me first invite our moderator, Mr. Nilesh Nakar. He's the Partner Financial Services Tech Transformation from eBay. Now, let me introduce you to our speakers, Mr. Mayank Jain. He's the Head Consumer Credit and Small Business Lending from Amazon. And Mr. Nitya Sharma, he's the co-founder and CEO from Simple. And Mr. Anup Agrawal, he's the business head from LazyPay. You may put down your question on the chat window and we will try to respond to a few of them during the session. With that, let me hand it over to you, Mr. Nakar.
Thanks. Thanks, Shivani. Hi, Anup, Mayank, and Nitya. Good to be talking to you all today. On the topic, democratizing credit with innovative solutions. Let me start with you, Nitya, on when you set up Simple in 2015. If we can talk a bit about what was the need, both from a consumer standpoint as well as from an SME standpoint that you think that you wanted to really address. And how did you go about doing it? A bit about that would help.
Hi, Nilesh. Thanks for moderating this and having me on the panel. So to your question, just to step back, the genesis of Simple was really a personal problem. Before starting Simple, I used to live in the US, work in the US, and obviously sort of like use credit cards very extensively, which is very commonly used payment instrument in places like US and mostly developed markets. And when I moved back to India, this is about five and a half years ago, my bank rejected my credit card application for a simple reason that in India, I did not have a credit score. But that, just set out a chain of events for me, just trying to understand what the problem is. And as I kind of went down the rabbit hole of payments, and obviously before that, I had no background in payments, have never done anything like this before. And so therefore, I was, I guess, looking at it from a little bit of outsider's perspective. But what I really saw was this problem that when you think about payments, it is really something that was built as a value chain 50, 60, 70 years back in a very offline first world, in a world where there was almost no technology back in the 60s when really Visa and MasterCard really came up as networks. And this value chain, which is now called the 4 or 5 party value chain, essentially gives retailers, first and foremost, absolutely no agency in terms of commerce. So the genesis of Simple was to ask a fundamental question. In today's world, where we have today's technology, which is unlimited amount of smartphones, connected to the internet, unlimited compute power, machine learning technology, and so on, is there an opportunity to reimagine a new payment network, putting merchants first, a network of retailers, so that retailers can be consumer-centric? So that's kind of like what the sort of the genesis was. And what we got inspired by was this concept of khata, like the khata or a house account or a tab that is very commonly used in India and a lot of the world actually. And this concept of the khata has been around for centuries. And so when you think about the khata is a way for a retailer, big or small, online and offline, to help to build a relationship of trust with their consumer. And when that happens, naturally, the consumer keeps on buying from them and so on. So it's not really, from that lens, it's not a credit product. It's not no one is taking a loan to use a khata to buy their grocery. It's really a way for a retailer to build a relationship of trust with their consumer. And that is something that is missing in the online commerce. So what we said was, can we take the idea of the khata, put it on the internet, connect it on a network, and allow retailers to build relationship of trust with their consumer. And on the consumer side, what we say at Simple often is the best payment experience is no experience. No one ever came to a retailer online or offline to make a payment. They came to buy, and yet checkout is where all the sort of friction happens. And a khata type thing is really the perfect example of zero friction checkout. So, that's a problem we identified both on the merchant side and the consumer side, and that's what we're building.
Interesting, Nitya. Now let me come to you, Anup. Extending from what maybe Nitya said, his trigger being declined a credit card, which really drove this. And, another interesting snippet of the best experience being a no experience, and being a user of your product as well, Anup, on Lazy Pay. What was your driving ambition to really think about this proposition, for setting it up? What needs were you trying to address?
Look, I think I agree with Nitya on most of it, right? I think today, if you look at commerce, purchase is coupled with payments. And ultimately, if you can decouple that two experiences, I can buy now and don't worry about payment. I think that is something which is very common in offline world. I think if you go to any store and if you have relationship, it is a default method of paying. There, but it's not there in an online space. I think it was just missing. And when Uber came and we experienced that payment of not paying, that cognitive overload not being there, I think that was the first time all of us experienced that experience, right? And that's fantastic, right? The best payment method is no payment experience. So if you go to Swiggy and if you want to order something, the cognitive overload of paying is high. We don't realize it, but it's there. And if you remove that cognitive overload, it helps merchant a lot. It, as Nitya said, it builds trust. It builds the customer to get back to you again and again because I don't have to bother about it. And that was the fundamental problem we wanted to solve for the merchant. In fact, that is what we think at LazyPay first is we solve merchant first, and the merchant relationship is already there. If we solve for merchant, we'll solve for the consumers, and that is how we think at LazyPay.
Thanks, Anup. Mayank, you know, as Amazon sit right in the middle of that entire supply chain, right, with the merchants, SMEs on one side, and then again the end consumers on the other side. Now, how did Amazon and you and your team really think about plugging some of these concepts in that entire experience and that entire value chain?
Absolutely. So first of all, good morning, everybody. Great to be among friends, talking about the programs that we have probably been discussing for several years, and working on them together. And great to be here, Nilesh, with you. I think you put it really well. We are really in a unique position where we have millions of customers on one side, and again millions of merchants and small businesses on the other side, and we are trying to make facilitate the commerce at a large scale. And for I'll probably add a slightly different perspective. While convenience has always been at the heart of it, Amazon Pay's genesis was to make payments trusted, convenient, and rewarding. And one of the key things that we saw in India, a few years ago, we realized that unlike many other locales where Amazon works, access to credit is a really large problem in our country. Like, we are cash habituated. We lot of country earns in cash, and that doesn't leave a footprint, right? Whether digital or offline, for lenders to be able to go out and give them credits, right? While an SBI has 400 million debit accounts, how many credit cards they have, right? So these are the kind of unique challenges that we saw in India. And we realized, looking at the voice of customer and looking at the offline behavior, that a lot of customers rely on credit, not just for their short-term needs of like a monthly khata, but even they can't afford a lot of things that they aspire for. Let's say a laptop for their child, or, a term loan for their business. And at the heart of our programs in credit and lending is how do we expand access to credit to a larger part of the country. Like, we are one of the most under-penetrated credit markets, whether it comes to customers or merchants. And our unique position of having insights on both sides, we feel gave us a responsibility to actually facilitate, expansion of credit. So for us, we see all lending companies, banks, etc., as our friends and partners in this. And that's why I have very different types of programs. On one hand, we have innovated and created, I would say, the largest marketplace of lenders on one side, where we have more than 25 lenders and their customers that they have already given credit lines to, can use those credit lines for their daily as well as high value purchase needs on Amazon. Similarly, on the MSME side, we have more than 11 or 12 lenders who work with us, and whoever they are able to already facilitate credit, we allow them to do it. But then we want to go 2 steps ahead. What we also do is we use our insights. We know customers ask for credit. A lot of customers say, I want to afford this phone, I want to afford this laptop, but I want to pay in installments. How do I do it? And we realize that, despite having 25 plus lenders, a lot of our customers still don't have any access to any credit line. And that was the genesis for the programs like debit card EMIs, buy now, pay later, or even our co-branded credit card, where we wanted to create a very trusted, convenient, and rewarding experience. Secondly, we didn't want to stop at just creating convenience or rewards. We really wanted to push the needle on affordability. And what we have seen is we have now a series of products where customers can upgrade starting from let's say a buy now pay later line, right? They can upgrade to a larger line and then upgrade to longer tenure EMIs and go all the way to getting a credit card, which is rewarding for them. So we are trying to address all types of credit needs. And that's where the whole innovation and the topic of today's talk is very close to our hearts. Now, how do we democratize credit, and how do we use innovation, as Nitya very well put, confluence of technology, data, insights, and customer experience to make it happen?
Yeah, some very interesting points, Mayank, and especially the whole aspect of not only convenience but also affordability. Right, and if we were to look at all the traditional credit cards and MDR charges and late fees and interest, I mean, for the end consumer or even for the merchant, right, it adds up to quite a bit. And I think Sumit from Kotak has actually put on a question saying that with the growth of BNPL products, how will it really impact the credit card in the future, the credit card business in the future? Any thoughts on that? And this is to all of you all, Nitya, Mayank, Anu.
Okay, probably I'll go first because we run I think one of the largest co-branded credit card programs, as well as a very large buy now pay later program. See, as I mentioned, the state of credit in India, the penetration of credit in India is so low, and so much needs to be done that we need everything, right? For different segments of customers, different things will fit, right? BNPL at the heart of it, the way, for example, when we created our BNPL program, it was very different from what you will see in the market. We allow customers to pay next month, but also pay in installments over 12 months, all the way, right? So it's not very different from a credit card if you think about it, but it caters to a very different segment of customers. It caters to a different need, of affordability, then followed by convenience. I think credit cards are more about convenience and rewards. That's the segment of customers that's going after credit cards. But and there is a segment for that. There is a segment for that. There is a need for that. But I believe both these products, are at such a nascent stage in our country, at such a low level, that we should be having 100 million credit cards and 500 million buy now pay later lines in the next few years. If all 3 people in this room do their jobs well, there's no reason for us to believe that buy now pay later is for the next 50 million and credit card is only for the top 25 million. So I believe they are not very different at the end of the day. In fact, when we say buy now pay later, that probably is the oldest financial product, right? All products are buy now pay later. Credit card is buy now pay later. A personal loan is a buy now pay later. So these are different solutions that can work at scale for different segments of customers because of their inherent way they go after customer segments. That's what my perspective.
I have a little different perspective on this. I think look, credit card today, the benefit of credit card is that it is accepted at most of the places, right? And that is why I think convenience factor just gets in very, very fast, and it's very well understood product as well, right? And buy now pay later is slightly different. I think buy now pay later, to my mind, starts with merchant, and it's basically a product which enables a transaction at the merchant, right? And buy now pay later can be a convenience buy now pay later, which Simple and Lazy Pay primarily does, and it can be affordability as well. But both of that basically is there to support the merchant. So it creates an equation between the financial company working with the merchant to offer a product for their consumer. So fundamentally, I believe that it creates a win-win between the three parties. When you do credit card in isolation, Amazon co-branded is, to my mind, is a buy now pay later product while it's a credit card. Uh, think about traditional banks. They reach out to the customer first, sends the card, and creates a relationship. The financial institution has to create a relationship with the consumer, and the consumer then has to go out and transact at the merchant. Buy now pay later, the equation is different. It works with the merchant to the consumer, and that reduces many things. That reduces your cost of acquiring a customer, cost of servicing the customer, and hence it's easy to provide BNPL to larger audience than credit card, let's say. And to my mind, co-branded credit card is actually a buy now pay later. It's not a credit card the way we used to think about it, right? So that's the way I think about how buy now pay later will always be a larger pie. As we move ahead, it will keep on expanding than a credit card, because it has just the cost layers of credit card will continue to be high.
Just a couple of thoughts there. I think the fundamental, if you take a long-term enough view, definitely the short term, whether you're thinking about a 5-year or a 10-year horizon, as Mike said, there is so much underpenetration. Like 70% of e-commerce in India is still on cash, right? And then so much of all transactions, physical and online, are on cash, and therefore, that pie will reduce, and there'll be so many instruments that will support that reduction. But when you take a slightly longer term horizon, maybe 10 year plus, maybe 20 years, I think the fundamental problem with credit card is this, and then the genesis is when it started and how it started. So credit cards were started in let's say the late 50s. Imagine the world then, right? There was absolutely no technology. And it started with a network, a Visa or MasterCard, enabling banks who basically held trust back in the day, and of course a consumer's bank account and so on, to kind of like take the customer and intermediate trust at the point of sale, right? And as the product evolved, the value chain evolved between the 50s and today, where it started in the world where it was just physical commerce and almost no technology, to today e-commerce and mobile commerce and all these things that we are doing today. And of course, imagine how commerce is evolving over the next 10 years. And the problem, what has happened is the value chain has nothing but increased, and more players are in the value chain. And what that leads to is a fundamental misalignment of interest between the value chain and its own customers. For example, not only in India but globally, retailers are asking payment networks, payment companies to reduce MDR. The reason retailers always ask that and almost fight it is they think of it as a rent. They are not, maybe 50 years back they thought of it as new business. If somebody's using credit card, they're getting new business. But today it's like rent seeking. And when you think about at a fundamental level, the business of credit cards is merchant pays a large MDR. A lot of that MDR is taken to create loyalty rewards that drives credit card usage to the consumer, which obviously we as consumers love. But who does it build loyalty towards? Well, it builds loyalty towards the financial institution or the bank or the issuer. And who's paying for it? It's a retailer who's paying for it. And the question is, what the fundamental question is, why? And there's no real answer except, well, that's how it works. Globally, retailers pay 350 to 400 billion US dollars every single year to make credit card processing happen, right? That's a significant rent on global commerce. Now, when you think about the consumer, one of the statistics is 40% of all credit card spends end up revolving, right? So what we all know is the fundamental business model, or where there is a lot of gravy and business in a credit card business model, is in revolving, right? Every issuer wants consumers to revolve. But the problem with revolving is, depending on where you are in the world, whether you are in India or US, Japan or Russia, you're paying very, very high interest rate, and of course, a lot of hidden fees. So for example, in India, you're paying, almost 36%, compounded interest rate, right? We all know that 36% compounded interest rate is financial suicide. No one should ever do it. And yet this business model really is built on top of that. So the fundamental problem is that there is a misalignment in incentives, meaning this value chain makes money when the customer does, when something is taken away from the customer, which is, I think, the fundamental problem that whenever a business has it, there is an opportunity to disrupt it. And that's what technology enables. It hasn't happened because of, not because this problem is not understood or people don't want to change it. It's just because the network effects of payments is so large, and technology disruption perhaps has not been there to the extent that you can actually have a wedge. And I think when you think about a long-term opportunity for buy now, pay later, that is probably what will be most looked at. 20 years out, you look back. We believe very strongly buy now, pay later would be a native to digital, native to internet, native to mobile version of a credit card that will put merchants and consumers at the center of the network and not at the periphery.
Yeah, agree, Nitya, Anup, Mayank, and that really gets me to the next question that typically we have when we see these, these build outs, and how do you really grow the business is really around adoption, right? So once you've launched, how do you really um, make customers sticky and ensure that they come again and again to utilize this offering. Right, and I think there are two, three aspects to it. Right, one is obviously on convenience. The other bit also is on how do you really assess credit for these individuals, right? What kind of lines should be given? What kind of limits? How do you really, and especially in a country like ours where a lot of people do not have any kind of a credit history, right? So how do you really address those issues, and especially in a digital journey, right, where you're not even meeting the customer? So maybe Anup, you wanna go first,
Yeah,
and then
yeah. So there are two questions you've asked. One is how do you get new customers and work in ensuring that they come back again, and the second one is how do you underwrite. I think let's take the first question first. I think while we have spoken about buy now pay later from merchant side, what are the problems we are solving with the merchant is if you look at our success rate of a buy now pay later for convenience product, it's 99.99. Literally, there is no drop off. If lazy pay appears at a checkout page, the transaction will go through, and so that's a great advantage today. 20 to 30% of the transaction actually fails at the merchant, right? So we have created new products and work with merchants. So for an example, there is a product which we launched with Book My Show and a couple of other players. If the transaction fails, we show lazy pay as a default option, right? Because we know it will succeed. So whenever there is a failure, merchant doesn't want to lose that customer and that purchase. Lazy pay is default as shown. So we solve those kind of problems. We know, standing instructions are only available on credit card and and few debit cards. It is a big problem. How can we work with the merchants to create those products? One of the ideas I've always thought, and it will work, and something I've been working closely, in-flight payments. In-flight payments is a big problem. We haven't solved it. I think buy now pay later convenience product can solve it. So working and creating new solutions with merchants. We've also tried ultimately, to drive adoption. We have tried Dunzo Pay Later, where Dunzo is saying that it's a pay later powered by us. Ultimately, it's a buy now pay later. It's provided by the merchant. So we have experimented with many of these new things, and some of it has seen very good adoptions. So failed transaction flow, a lot of merchants are coming back and saying, yeah, 30% is a big problem for us. How can you solve for that? So that is where we have added value, and we are going up the value chain in terms of problems we are solving. And from that, so once the customer use it and feels, yeah, right, it makes a lot of sense, the retention hasn't been a big problem for us. So that's on the acquisition and how do we retain the customers. On the underwriting, I think we don't use a lot of bureau or traditional data to underwrite, because we all know it's very thin right now. So we look at digital footprint of the customer, the payments data which we have with our partner pay you. We also look at social graphs. So how people are connected, right? So if I'm connected to Nilesh and Mayank and Nitya, it speaks differently about me. So we use social graph. We look at payments data. We work with merchant to understand what are their best customers. So basically working on these three big pillars of data to underwrite a large base of customers. And those have been the pillars of underwriting for us.
Mayank, thanks Anu for that. Mayank, compared to I mean what Anup said right around payment data or a social graph and things like that. I guess Amazon would have far greater insights, especially sitting in the midst of a value chain, that entire supply chain as such, right? So do you all look at it a bit differently? Obviously, the same question of adoption and stickiness.
I think great question, Nilesh. Let me break it into two parts, as you mentioned, right? Let me first talk about maybe the adoption piece. I think it's a simpler problem to solve because, as all bankers will tell you, it's easy to give credit. And the problem is whether it's going to come back or not. And at the heart of it, what we have seen is because the Indian credit market is so underpenetrated, people have actually not tested many segments. Right. Whenever you'll have a chat with somebody, in the lending industry, they'll say, "Oh, these customers, new to credit customers, are risky." They're not risky; they are untested, right? And when you actually go out there and give them credit, we are all pleasantly surprised. We love it. The loss rates at our programs are so minuscule, and that's why we see a lot of lenders wanting to work, expand the horizon, expand the base that they can go after. So at the heart of it, why the adoption of credit in India has been low has been that the traditional lenders had their own constraints in knowing whether a customer is credit worthy or not. That's at the heart of it. That is one part. I would say an equally and big problem otherwise has been ability to issue credit at the moment of truth. Right? You want to buy, let's say, a suitcase for your upcoming travel. You don't have time to go to a bank, apply for a loan, get a loan, use that money, go to a shop and buy a suitcase. I'm just making it very extreme example, but the point is two constraints for the lending industry in India that has led to this low penetration is lack of context or insights about customers' behavior, whether they will be credit worthy or not, and just the cumbersome process of for the customer to avail the loan and for the lender to process the loan and give it to them. I think with the digital products that you are seeing today, and I'll not just talk about buy now, pay later, and that's what I was saying, the boundary of some of these products is now getting just blurred, right? If you can issue a credit card at the checkout instantly, right, and you can use it to make a purchase there and then, then to me, that's buy now, pay later in a way. So what we have been able to do is, at the heart of this adoption is, the customer experience, that it should be completely frictionless for them to not only get the line and then use the line. So that is at the heart of it. First, how do we make it instantaneous? The second piece is ubiquity, right? I think Nitya and Anu both spoke about a lot of merchants here. I think for the customer, if you see, you don't want a different credit line for this and then give different credit line for that, use cash here and then use debit card here and then use credit line there. The more merchants, the more ubiquitous network you are able to create of acceptance and issuance is what drives adoption. And we obsess about these two things really, right? The third thing that we have seen for some of our credit programs, whether it's debit card EMIs, normal EMIs, or buy now pay later, I think one thing that we have been able to create is a very healthy and I think one of the largest networks of merchant subvented loans. Customers don't want to pay interest. Like they want the loan instantaneously. They want it to work everywhere. And they don't want to pay an interest on top of it, right? That's the most customer-centric way to do this business. And what we have been able to create, we have been able to demonstrate, first of all, right, for the merchants, that enabling credit enhances their ultimate business goals. Customers buy more, customers become more sticky, customers do more transactions, so much so that we see, buy now, pay later has one of the highest downstream impacts for our merchants, right? Compared to any other instrument, even more than credit cards sometimes. So it's about creating a ubiquity, creating, going beyond what we are doing. And what we have done with the merchant subvented network is we see 3 out of 4 installment products purchases on Amazon happen through a merchant subvented loan. right? And the merchants are more than happy to subvend it. And we allow small and large brands, big brands and big sellers to enable those no cost EMI offers or those rewards on these credit lines as long as it works for them. So I think that's the three-pronged approach we use. On the data, I would say I will take actually an example of an MSME. Let's say today again we talk about customers a lot, but MSMEs actually face a larger problem in terms of getting access to credit, right? Especially the small businesses. Like while they will account for 30 to 40% of India's GDP, 5 to 10% of total credit goes to these small merchants. What we have seen at Amazon is, it's not about the credit data or anything. I know how much customers love you. I know your deliveries are on time. I know that your return rates are very poor, or very, very good. These are the kind of insights we have. And what we do is we work with lenders and partners like Anup and Nitya here. So we share these kind of propensity. We highlight that, okay, these are the merchants, they are loved by the customers. Would you be willing to start giving them a line? So we don't do the underwriting. Underwriting is done by the lenders and our partners. But we are able to surface these lines to these merchants, right? Which then get a line. And what we have seen, for the last 3 years, I would say, and during pandemic, absolutely, the loss rates on our books, both for our customers as well as for our merchants, have been very, very low. Very, very low. And that has resulted into lenders being willing to give interest rates sometimes up to 4 to 5% lower than what they would give to the same merchant if the merchant approached them directly. So I think that's where it really becomes sweet, that you are able to go to a larger segment of customers and merchants. You are able to reduce the cost of getting credit for them. And then you are able to make it so convenient to get it and use it. That really makes the flywheel go.
Nitya?
Yeah, I'll go next. So again, like Nilesh, I think you have two questions. One is how do you drive growth, and then of course retention. I'll answer the retention question very quickly first. Look, in the end, right, the thing about internet is that the switching cost for a consumer is zero. So I can move from this website to the next or this product to the next within a second by pressing a button. And therefore, the only thing that matters is great user experience, high degree of transparency, and a long-term view of a customer relationship, right? A lot of times businesses are built on transaction revenue and like building a transaction and making money out of it. Of course, in the end, it's a business. But sometimes those transactions could be short-term from a long-term, business relationship building point of view. So as long as you're building a product that has great user experience, and when I say great, the best, because the consumer will just move to the best because it's so easy. And then, of course, you have all the underlying factors, like in this case, high degree of transparency, and you're thinking of the consumer as a full cycle of not just the checkout experience or this experience, that experience, just like the one cohesive experience, the consumer will retain and kind of like, keep on using your product. Obviously, one important aspect of any payment product is network, right? If a consumer has multiple places to use something, then of course the value of that product just continues to go up. And therefore, those are the couple of things we always focus on, keep on building, doing things better so that we can keep on increasing the user experience, increasing the size of the network so that the consumer retains now and retains later. In terms of acquisition, as I mentioned earlier, we think of ourselves very much like a developer platform. We are a merchant first sort of platform, and therefore the entire acquisition happens through that funnel where we are helping retailers increase their revenue, and we increase the revenue because we increase conversions. One of the statistics, interesting statistics about India, of course, conversions are different in different segments of retail. But when you think about, a retail, let's say e-commerce, 90% of all e-commerce in India, as we all probably know, is on mobile. And the conversions is 50 basis points, 0.5%, which means out of 100 people who come to the top of your funnel, less than 1% will actually buy. So you are spending a lot of money on marketing, Instagram, Facebook, all the other things that we all drive to on the top of the funnel, but only half a customer actually buys. And therefore, marketing becomes incredibly inefficient and so on. And when you really break down why do 99.5 people drop out, you can really think about three real points. One is trust. Second is convenience, friction of filling up stuff, OTPs, checkout, and so on. And then last but not the least, we all know on mobile, 20 to 25% transactions, doesn't matter whether you're doing the credit card, debit card, or UPI, they just fail. And sometimes people just drop off. So, anything that can increase conversions, is a tremendous value to retailers, and they will just want more and more customers to use you. So that's kind of like how we think about sort of long-term value creation and long-term growth of our platform, and of course, with us, our retailers' platforms.
Thanks, Nitya. And if you really triangulate with what you all mentioned around convenience, the cost of the transaction, as well as trust, and I think there are quite a few questions in the chat box as well around collections, right? And to Mayank's point, saying that a lot of these customers are not risky, but they've been untested. We don't know what their credit behavior is. And if you just look at the last 1.5 years, at least what Mayank is saying on their platform, it's been very, very, the non-performing, in the traditional parlance, the way it's called, is very, very low. Right? But if you were to look at it a bit more broadly, like where you look at a longer credit cycle, and I'm sure Anup, you, Nitya, Mayank have seen it. If you were to look at a slightly longer period of 3 to 4 years, any business on the lending side should have a strong mechanism to say how do you collect, right? And obviously, the traditional businesses have looked at it very, very differently. But when you look at the digital businesses, right, is there a different way to really look at how do you really manage, I wouldn't say collections, but the overall customer service angles of it, right? Because as you said, we want sticky customers. We want them to be with us for a longer period of time, to grow that relationship, look at it in the long term. How do you really manage the servicing aspects of it, as well as ensuring that you minimize leakages from a credit standpoint? Anup, you wanna?
Yeah. So the way we actually look at it, and I think Mayank in some ways explained it, we believe in growing with the customer. So, and what we have generally seen is if there are low intent users, they actually drop out of the funnel right in the beginning. So they will actually not pay. And to your point on collections, we actually want those customers to just go away, who has low intent, because otherwise we bring them back and the cycle will continue. So it's very simple for us. We have kept it very, very simple. If there are low intent customers, let's get them out as early as possible so that we are left with people with high intent, and that is absolutely fine for us. And on the customer service side, ultimately we believe that, right, as a fintech, that is the only differentiating factor, right? What kind of services we can give to our customers, and it has to be transparent. It has to be, we should not bother the customer a lot. So hence all of these actually drives our collection of philosophy. If the customer doesn't intend to give, and it actually, if you look at our delinquency curves, it speaks to it. We actually flush out a lot of customers early, and then from there on, we just grow with the customers. We start small, but over a period of time, you'll see the customer engaging with us a lot more. Their limits increases a lot more, and we create a depth of relationship which is very, very meaningful when compared to what they started off with. So that is our simple strategy, and all of our processes are aligned to that theory. Yeah.
Mayank, Nitya, any different thoughts on how do you all look at it? Although Mayank, I do understand a lot of that goes back to the tie-ups you have with the financing partners that you have. But any thoughts, and then Nitya?
So I think one of the learnings that we have had, when I talk about the untested segments, a lot of these untested segments, they have a lot of anxiety to sign up for a new credit line. And the anxiety comes from, oh, what will be the penalties? What will be the late fee? How will that work? If you listen to the voice of the customers, we talk about these customers all the time, and we listen to them very, very closely. I think a lot of first-time credit users are anxious. You ask my parents, you ask my mom, she will say, I don't want to sign up for your products, man, because बाद में क्या penalty लगेगी? I don't know. And people in India, and world over actually, but especially in India, they're averse to going beyond their means sometimes, and scared of what will happen in the fine print, right? So I think there are two things here. One is about, of course, about transparency, as Anup and Nitya, and we all discussed already. I think one simple thing that we have seen, which has really worked for us, is that a lot of customers we have seen who miss out on the payments, right? Simply just forget it. We have seen this happen time and time again, and that's why when you people talk about soft collections and just nudging customers, what happens is basically customers have forgotten, and if you remind them, the customers at large, largely customers don't want to default, right? So if you think about it, the way we solve this is being responsible about what credit we give, and then make it super convenient for the customers to repay. That even if they forget their payments or their bills, for this they don't have to remember one more thing, that I have to pay one more bill. That's the philosophy we have. So what we do is, up to a very small amount, we let customers, use the line, not set up any auto repayment, up to them. But after a point, we say, we give an option to make an auto repayment, set up auto repayment upfront, or beyond a particular stage, we'll make it mandatory. Now, what happens is, and customers love it. Actually, we see a lot of adoption. The customers who have tried the product out, then they don't want to remember every month that, okay, I have to pay my bill, right? There are now businesses there which are just helping customers remember that they have a bill, right? And they have to pay it. And what we are trying to do is, going with the same philosophy of what Nitya and Anup said, best experience to have no experience. What we want to do is set up in one go an auto repayment that then takes away this whole hassle of repaying and remembering it every month. That works beautifully for us on the customer side. I don't want to, share the detailed numbers, but most of our customers, don't even remember or don't even know that they have paid their outstanding of the month already. Similarly, on the merchant side, we replicate the same thing. We are in a great position, first of all, to provide early warning signals, right, to our partners. Like the business is suddenly dropping, if the customer complaints are increasing, if the cancelled order rates are increasing, right? These are all kind of signals that the lenders get, and they are able to then, take action they have to take. But at the same time, we allow our merchants to set aside a small amount of their daily or monthly sales to automatically go to their loan account. So they don't have to remember to pay that loan amount. It's automatically, or they get this option, and they can just choose that account that a part of sale for the outstanding monthly amount can then go to that loan account. And that's how majority of our sellers who take loans from us actually repay their loans. So it's about making it convenient, because ultimately these untested segments, they have this anxiety. Being transparent upfront, making it simple for them, and then making it convenient so that they don't have to remember yet one more thing that they have to pay.
Yeah, all these points definitely, I will not reiterate, but all of them are very important to appreciate. And I think if you summarize all of this, if you are thinking of collections as a specific strategy to run a business like this, you've lost the plot to start with, right? So collections can't be at the center of this. I think one thing that perhaps is worth double clicking on is, and I'm looking at some questions here on the right, and I think there is always this question, right? And I think BNPL is this catch-all phrase that we all use right now, and is it credit, is it this or that, and it's all of the above. But I think the fundamental transformational aspect of what is possible is it's an example of a data-first application, right? So when you think about a credit card, think about this: you get a credit card, let's say you got it 1 year ago or 5 years ago, and that credit card stays the same for the most part. And it's not about, the physical form factor or the line of credit, but it is exactly the same thing. It's not personalized to you. It's not getting better with time. The loyalty rewards are basically the same that you got with. The credit line roughly is the same, and so on. So it's almost like, if I were to compare a music equivalent, it's a CD, right? You got a CD and there are 10 songs and that's all you get, right? The question is, are you building a Spotify, right? Are you building a data first intensive application that just gets better with time, more personalized for you? And when you look at it from that, and of course that's possible because that's a fundamental transformation. If you really reimagine the value chain and connect the merchants and consumer, there is a ton of data in the middle. One of the fundamental problems again of a credit card value chain is this data is fragmented. There are 4, 5, or maybe even 10 folks in the middle. Data does not flow between each other, and therefore data is sitting in silos. But if you want to reimagine this as a data first like application, like we all are used to in so many parts of the world, of parts of our life, like Google Maps. Google Maps is a classic example of a data first application. It just gets better with time. It gets more transformational, more personalized. Suddenly what happens is your ability to personalize underwriting amount risk becomes incredibly minute and nuanced. And that has to be the fundamental, way to think about the business model, the revenue, and of course the losses. Therefore, so I think that's probably how one should think about it, and we definitely do. So you are really thinking about the customer and the risk. Therefore, at every single point in time, as opposed to at the beginning or at the end or once in a month or once in a quarter. And if you do that, then you are really paring back risk whenever there are early warning signals, as Mayank said, so that you can manage it better. And of course, in the end, there is some aspect of servicing and collections that needs to be addressed in a very consumer-centric way. Because when people do not pay, there are hundreds of reasons. We from in the most general form, collections are thought of, somebody did not pay, they are bad people, let's go collect from them. And that is really not the right way to think about it. People don't pay for multiple reasons. It could be anywhere from forgetfulness to having an issue with the transaction itself, to so many reasons. And how do you then address servicing with a very consumer first lens is going to be critical, not only to drive the business model, but also to retain the customer.
Agree. Thanks, Nitya. I guess we are down to the last 2.5 minutes, and there are quite a few questions on Open and account aggregation as well. Any thoughts on how are you all thinking of reimagining some of your offerings basis the account aggregator framework and the capability it's going to give?
I'll probably go first because I believe the OCAN and the account aggregators are relevant for both customers and merchants, but far more relevant for small merchants, right? And they go to the heart of the problem that I was saying, right? That the lenders today lack context, lack data to be able to take some decisions. And we are very hopeful and we are very excited that this kind of a new revolution is coming. It has the potential to really level the playing field for merchants to really, for the borrowers as well as for the lenders. It can really bring that next level of transparency if done right. I think it's pretty nascent right now. We are very keen to be part of this journey and partner with the platforms out there that are trying to build this. In case of data, right? In case of underwriting, 1 + 1 is never 2. Right? If I say you had only the bureau data and you only had the, let's say, the social graph data that Anup was talking about, right? If you were to do underwriting with them in silos and then try to put it together, it will be 1 + 1 = 2. But if you're able to get that all together in one go, right, and then do it for the lenders, then 1 + 1 becomes 5. So that's, I think, at the heart of it. It should help revolutionize credit. Is what I believe. We are very cautiously optimistic about it.
Hello.
So the way I look at it is ultimately it's at the core of your democratization of credit. AA is important. It's basically giving the power of data, which was actually with the banks or the telecom providers earlier, back to consumer, and it is basically putting the power back to the consumer, to whoever they want to give that data for them to look at the data and underwrite the customer. So I think it's fundamental. I think it's a fundamental move. At the core of it, it's actually earlier, the way, if you think about it, my banking information is only with my bank, And if I have to give it to someone else, either I give a bank statement, or if there's a lot of login of net banking where you need to have an insane amount of trust with the lending provider to give that kind of information. Just abstracting that information out and giving that consent framework controlled back to the consumer, it's super powerful, right? It's my data, I decide who gets it, right? And that is so powerful at the core of it. And I think this is another UPI moment. Many of them have spoken about it, but I think it is fundamental to consumer power. I think it's giving back the power to the consumer. Today, if you think about it, a consumer can only go to the bank with which they have a relationship for a loan. And it is very well understood, right? You get a credit card only from the bank where you have a relationship with the bank. No other bank is going to give it. But now that's going to change. And it is that moment of democratization. It's basically power moving back to the consumer. And this is very fundamental. So I am very excited about AA. So that's the way I'm thinking about AA, account aggregator. This is an important framework.
Nitya, any closing this thing on AA before we give it back to Shivani?
Yes, absolutely, and it's just not about A as I think about it, right? I mean, as Mayank and Anup mentioned, right? It's really about open data, right? And I will just bring the merchant framework here very quickly. Today, again, like if you were to really break down the fundamental, problems in the traditional way of thinking about either BNPL or even credit card is, why should MDR or interest rate be same for every purchase? Because the reality is every purchase is different, right? If I'm buying this versus that, there is just so much context in the middle, which is which retailer I'm buying from, who's the customer, what is the size of the transaction, am I buying, the SKU, and so on. And naturally, the progression here is to be able to price risk in the most granular way, so that you're bringing more efficiency into the transaction itself. And of course, as Mayank said, and Anup said, and we do it as well, like you're always looking at data sources so that you are able to take that data and price risk to that point and provide the benefit of pricing to the retailer and consumer, right? And that's how basically you drive adoption and innovation. So I think therefore AA is one more step that helps you help the customer and the retailer bring more efficiency and actually transparency in the ecosystem and pricing and in the consumption of the product itself.
Thanks, Nitya. Thanks, Anup and Mayank. It's been a very engaging conversation. Thank you so much for your time. We are over by 2.5 minutes. Shivani, back to you.
Thank you, Nilesh. Thank you, everyone, for joining us today for this session. I would also like to thank our audience to join us this session. This session is presented by AWS. We are signing off. Thank you so much.